Can you see the difference between this winning trade right here and this losing trade right here? Probably not, right? And that's exactly my point, because there is no difference. When we look at price action, overall, it's very similar. It's almost the same. And here it is not about price. So what makes the winning trade a winning trade? There's an underlying factor that is extremely important to understand to increase your win rate and to increase your overall profits. And that underlying factor is exactly what we are going to go over today. So first steps first, what is that underlying factor? What am I talking about? Well, here on this losing trade, we see this gray box, which is fair value gap. We have fair value gaps going higher right there. We have some type of an entry confirmation right there. Entry on the order block and on the fair value gaps itself. Why do those fair value gaps not hold? And ultimately, why is this a losing trade? When, in comparison to this very similar price action, the gray box is a fair value gap. After that, we have fair value gaps higher again, the entry confirmation, entry of the order block right there. Why does this gray box, that fair value gap, actually hold, whilst price action is almost the same? And of course, I understand, yes, there are slight differences in price action, but that's not the most important part, because there's always going to be a slight difference in price action. And price here, in the winning trade and losing trades, they are always going to show you something. There's always going to be some kind of setup, some kind of trade ID every single day. But what makes a trade a winning trade? Well, in order for this trade right here to hit take profit, what does it need to do? It needs to move higher to hit take profit. And I know that sounds extremely stupid, but think about it. If price doesn't move, then your trade will never hit take profit. It will always be closer to my actual stop loss right there. So then the question becomes, well, why does the market actually move? And the market moves because of time. But not the fancy word time that most traders think about. No, we are actually going to dissect this fully. Time is oftentimes used as a marketing word. It's a buzzword. Whilst it doesn't have to be that difficult, because time is simply said volatility. And volatility makes the market move. And even volatility to me is always a little bit of a vague word. It's not that clear what it actually means. Where I like to refer to it as energy. When you have energy, for example, most likely you would want to move, you want to do something, right? And the opposite is also true. When you don't have a lot of energy, what do you want to do? You probably want to sit down, want to sit on the couch, want to sleep a little bit. That's why we go to bed in the first place, because we're tired, we don't have energy. So when we have energy, we like to move. When we don't have energy, we don't like to move. That's the same exact thing in the market. So what then brings that energy to the market? Well, there's two types. There is higher time frame time and lower time frame time. We first need to go over the higher time frame time. Higher time frame time is when we want to know if a day is actually ready to continue higher or continue lower. So if the day itself will actually have good movement, and if the day itself will actually have high probability of showing this trade, for example, a winning trade. And that is done through news, the economic calendar. The economic calendar makes the market move, makes the higher time frame move, which of course then hand in hand makes the lower time frame move as well. The lower time frame is what we're going to go over later on in this video. Now, to make it easy, I want to focus on the economic calendar for the US dollar. I am, by the way, using Forex Factor, no affiliation or whatsoever. This has always been my go-to economic calendar, the most reliable in my opinion. Then if we take a look at this losing trade that we had this 1 hour fair value gap right there. Then going into the 1 minute, we again saw 1 minute fair value gaps going higher. Absolutely perfect. New 1 minute fair value gap going higher there as well, which in itself again could be a great entry. But ultimately, why did this 1 hour fair value gap right there not hold? Why did it not push higher right there for us to hit take profit? Well, look at this day right here, which is, by the way, a Sunday, 18th of February. We're going to count this as a Monday. So Sunday to Monday, where both of those days, we don't have any news besides US dollar bank holiday. Here we're trying to trade Euro US dollar. So ideally we want some US dollar news. And which exact news is exactly what we're going to go over. Whilst if we look at the winning trade, we have this 4 hour fair value gap right there that actually helped, that pushed price higher right there. which on the 5-minute had a beautiful confirmation to actually push higher and make the winning trade possible. Why is this? Well, looking at the economic calendar again, and if we go to the previous week, then on the previous week right here, we see this winning trade was taken during Friday, the 16th of February. Friday, the 16th of February, we had core PPI and we had prelim consumer sentiment right there. 2 red folder US dollar news. And that is the exact difference. But just trading red folder news will not do it, because that will also cause you to lose a lot of trades. Because there's something called the big three. And the big three is US dollar CPI, FOMC, and NFP. Those 3 news events have a 1-day spread. What do I mean by that? Well, here, for example, on this last week, we see CPI, core CPI for the US dollar. Whenever you have a big 3 news event, so again, CPI, FOMC, and NFP, you want to avoid the day before right there, because even though we have US dollar orange folder news, that means nothing. The chances of consolidating are increased right there. Why is that? Because the big 3 takes up so much volatility that ahead of that price action, we are more likely to consolidate, and then afterwards we will explode towards one side, or first take out one side to then move to the other side to avoid traders from being a part of that move, to then make the real move. This happens the day before CPI, and also we see 8:30, so the 8 hours and 30 minutes before CPI as well. After that news release, it is perfectly fine to trade. When it then comes into your PD rate, then shows your entry pattern, for example, like we see right here. On this EU trade, on that Friday, we see PPI. PPI right there was just the catalyst for this setup. Why? We were always expecting to move higher from this 4-hour FVG gap, which we even mentioned in the previous video live. Then before we even hit the 4-hour FVG gap, there is no reason to go into the lower time frame just yet to look for our entry confirmation. So once we hit that 4-hour FVG gap, then we can go into the 5-minute. And when we are in the 5-minute, then PPI right here, this huge candle, that 8:30 candle, is where the volatility again comes in. And that is simply said where eventually the entry presents itself, because the time and the fair value gaps right there are in agreement. But then right here, we also have at 10 a.m. right there, we had that US dollar consumer sentiment that we saw. Is that tradable? Yes. Everything besides the big 3 can be traded before, during, and after. And the reason for that is, again, big 3, CPI, FOMC, and NFP are so extremely volatile that in live conditions, not demo conditions like your favorite guru might show you NFP profits, but actually live conditions, if that goes against you and it moves against you, it does not fill you at your stop loss. It fills you way below that, because in that small time period, there is no one trading. Brokers deactivate trading during that actual period. They are not obligated in any shape or form to fill your stop loss at that moment in time during those heavy news events. So if your stop loss gets hit, then it doesn't get hit and you get filled way below that. So for example, here, if we were to trade this during actual CPI and we enter on the exact moment CPI happens and were to come to our stop loss, if for example we took a short right there, then we would not get filled right there. Yes, if you're trading demo, absolutely, you might. But live conditions, you might get filled right there, losing double, triple, 4 times, 5 times the amount you actually risked. So then you are essentially trading in negative RR conditions, meaning that's not risk management, that's not trading. That's just purely gambling. Why is it gambling? Well, if there's no risk management involved, then right there, in order to avoid blowing your account, you would need to have a 100% win rate or even close to a 100% win rate to pull this off. No one is going to have a 100% win rate. Absolutely nobody. If they're telling you they have a 100% win rate, it's absolutely bullshit. So even if you lose that one time, and that one time might blow your account, even then you are unprofitable. Might as well go to a casino and put everything on red constantly. So we don't want to trade ahead of that CPI and ahead of that FOMC and ahead of that NFP. But after it, how does that work? Well, again, like we showed, right? After CPI, FOMC, NFP, it's perfectly fine to execute 100%. And the 1 day spread we talked about, where you want to avoid the day ahead of it, you can perfectly fine trade the day after it. So even though on that Wednesday we do not have red folder US dollar news, it is perfectly fine to trade that day. Then Thursday, also perfectly fine to trade. Friday, also perfectly fine to trade. Then if we look at the next week and we just go over multiple weeks to ingrain this into your mind. Monday right here, do you want to trade? No. Tuesday, do you want to trade? No. Also, because it doesn't have US dollar red folder news, but more importantly, because it has FOMC the next day. So avoid Tuesday. Then also avoid Wednesday until after FOMC. Then right here, Thursday is perfectly fine tradable. Friday, is it tradable? No. Friday, we don't have red folder news, so I want to avoid it. So before I give you the full checklist right there to go over so that you fully understand this, it's important to understand, again, these are all probabilities, right? So will you have clean setups and nice trades that play out when we don't have news supporting the ID right there? Yes, 100% you will. If during that 10-day period, you were to take one trade each single day, let's say you lose 8 out of those 10 days and you win 2 of those 10 days, you would need to catch 9 RR combined over those 2 winning days to actually be profitable. Whilst if we look at the higher probability thing, when we do have news supporting the ID, let's say 5 out of 10 days are now clean. And that's, again, taking it very easy, not over exaggerating, taking it very easy. Let's say 5 out of 10 days, 5 winning days, 5 losing days. You would need a combined 6 RR in a total of 5 days to be profitable. Well, that's a lot easier, right? It's a lot easier to do. So seeing people say, well, this day had no news supporting the ID right there, but it still had beautiful trades. Yes, you don't understand how trading actually works, which is, again, it's all based on probabilities. Now, the checklist you want to go over for your higher time frame time before we move into the lower time frame time. The big 3 is what you want to avoid the day before and the day itself, the time before that. After that, it's perfectly fine to trade. The day after, no matter what, is also perfectly fine to trade. Besides the big 3, if we have red folder US dollar news, like we're seeing on this Thursday right there, that is perfectly fine to trade. That's perfectly fine to execute before, during, or after that news release. And when I refer to FOMC, I refer to FOMC meeting minutes right there. When I refer to CPI, I refer to CPI right there, US dollar. And when I refer to NFP, I refer to non-farm employment change right there. And then your question might be, well, Arjo, in a week like this, do you then just don't trade? Like, what do you do? Well, of course, there are multiple pairs out there besides the US dollar, which are also called the crosses. So if we take a look at the list right here on the right side of our screen, then the Forex majors right there is something I would avoid until we have had the big 3 news event, which is the FOMC meeting minutes. But if we move to the crosses, which is this list, for example, we have Australian dollar news, we have Canadian dollar news, GBP news, Euro news, a bit of New Zealand dollar news. So Australian dollar, Canadian dollar, Australian dollar CHF, GBP Australian dollar, for example, are all perfectly fine tradable because that is where the volatility is going to be. So higher time frame checked off right there. Lower time frame, we can reveal that right now because now we need to understand the following things. What brings the volatility to the lower time frame? That is where kill zones now come in, or another word, a fancy name for sessions. So for example, if we want to understand if a fair value gap is actually going to hold right there, then the fair value gap itself, like we saw on the higher time frame time, is not enough. We also need to understand if time is agreeing with price. If time is agreeing for that fair value gap to actually hold. Where right here, we see this fair value gap does not actually hold because we come below this swing low right there before we actually continue higher. So why does that fair value gap right there not hold? For indices, and here we are on NASDAQ currently, it's important to understand the following kill zone. Focus on your trades between 9:30 a.m. and 4 p.m. New York local time. Lunch times, all that stuff doesn't really matter. And I'll explain to you why. So right here, if we want to wait for that 9:30 open again, for that 9:30 kill zone to start. Then right here we see at 9:30, that's exactly where the volatility comes in. Time often tells you whatever price wants to do, meaning once time is sort of activated, time right there comes into the market. We have equities open, for example, like we have right there at 9:30. That stings into a discount rate, into a 1 hour discount rate in the form of that swing low. That then shows our entry pattern in the form of that 5-minute fair value gap higher. So then we have time and price in agreement, where it is that simple. Trust me, it is that simple right there, where time telling you what it wants to do, because simply said, it stings into your PDRA, shows the entry pattern. That's it. Where that entry is perfectly fine. But this entry, again, why does this entry lose right there? We don't have time supporting the ID. Now, for indices, it's also important to understand it's less reliable on US dollar red folder news. Why is that? Because the indices are already extremely volatile with equities open. So every equities open, which is again 9:30, that's the start of the kill zone until 4 p.m. That is already extremely volatile by itself. Where in Forex, it's the opposite, because in Forex, you are almost reliable on those US dollar red folder news. Kill zones in Forex, and I might get a lot of comments towards my head, but from my experience, it's very true. And from the data as well in my trading, it is very true. Kill zones in Forex are less relevant than indices kill zones. And again, I'll explain why, because kill zones in Forex just generally don't bring in the amount of volatility in comparison to an equities open, where the volatility for Forex truly comes from that economic calendar, not so much from the kill zones. Where the kill zones in general for Forex right here is, you have London open. London open is from 2 a.m. to 5 a.m. New York local time again. Everything I mentioned is New York local time. After that, you have 7 a.m. towards 10 a.m. New York open, or the New York kill zone. Then from 10 to 12, you have London close. And then from 8 until 12 again, so making the full circle, is where you now have the Asia range. But there's a lot of factors going into this. Then what about the period between 5 a.m. and 7 a.m.? Because that is known as the lunchtime. Can we execute during that time? For your Forex pairs and for your Forex majors, so the one I have on the right there, it is perfectly fine to execute between 2 to 10 a.m. Because let's say price is moving higher right here. It is having a PD rate in the form of that fair value gap right there. And we have lunchtime, which is actually true at that moment of time. We have 6 a.m. right there and 6:05 until 7 a.m. But we can see this lunchtime is more volatile than whatever London Open was doing right there. Why is that? Well, that simply is because price there is ready to continue higher. And what do I mean with that? It's again showing the discount rate, showing the entry pattern. So it's willing to continue higher. If you are about to have lunch and you are in the middle of a project and you're about to finish it, I think 9 out of 10 humans, it's sort of this human nature that you want to finish the task first before you go to lunch. It's just a better feeling. That's the same in the market. Why would anyone go to lunch right there if it has a job to fulfill? Meaning moving from the discount rate towards the premium rate right there. And 2 until 10 a.m. in general is true. But what about the Asia range? The Asia range is not a range if it's an Asia pair. From 8 p.m. until 12 a.m., it's called the Asia range. And Asia range is where usually it is taught that it's a range. It's a consolidation. You want to avoid that price action right there. But again, that is also extremely general. Because if we look at Australian dollar, US dollar, that's actually very active during the Asia range. So during Asia, it's perfectly fine to execute on Australian dollar, US dollar. The same goes for New Zealand dollar, US dollar. The same goes for US dollar, JPY. What do they have in general? Asia pairs, JPY, New Zealand dollar, and Australian dollar. For those pairs, it's perfectly fine to execute during Asia as well. So why does this gray box right there hold? Why has this fair value gap right there held as well? Pushing price higher. Why are these fair value gaps and every fair value gap that we see after right there not hold, as in has not created a new fair value gap off of that and has not been respected? Time. It's not because of price itself, it is because of time. So if you've watched the previous episodes of Market Mastery, everything I told you right there and every concept we have gone over is all invalid for me if time is not supporting the idea. Price is always going to show you something. Time is the differentiator. Now, if you are interested in a shortcut and you are willing to learn how to be able to call this price action live like we have been consistently doing, then again, the spring enrollment, the 1st of March, is opening up for the masterclass. Limited spots available, not everyone will be able to get in. You can apply, and after that, you will also still have a chance to get in. So please, if you are interested in that, pay close attention to my social media when 1st of March is approaching as well. And if you don't believe my word, then again, you can go to arjo.io where you will see other people say the exact same thing. Where again, the results are also speaking for itself. All right, perfect. Thank you.